Ladies and gentlemen, boys and girls, welcome to another episode of Off the Sidelines Property Podcast, where we have our special guest with us today, Coleman Booth, our expert mortgage and finance expert. Thomas, welcome to the podcast, mate. And if you don't mind, introduce yourself and tell us what you do and why you do it, mate.
Yeah, for sure. Thank you for having me on us. I'm obviously a residential mortgage broker specialising in resi and commercial all around Sydney and Australia.
Awesome.
We're obviously just a middleman between ourselves and the lenders, or your clients and the lenders. We assist on the finance side of things, assisting with figuring out how much you can afford, blah, blah, blah. Basically taking all the boring stuff off the customer's hands and assisting on that side too, as helpful as possible. Yeah.
Okay, awesome. And where you guys based now?
Mate, we're based in the south, so Penshurst area. Yep. But we're predominantly around the Alexandria area in the city. But mate, we're all over the joint. So I'm on the road most of the time, as you are.
Yeah, awesome. Awesome. And Thomas, just give us an overview of the clients you help. So why would a client come and see you, and what types of clients do you typically service?
For sure. So we get a whole range of clients, from your first home buyers, professional investors, property developers, really anything involved on the property side of things. Mm-hmm. Obviously every customer or different client needs different needs, specialties. For example, investors need more, obviously, knowledge based on the policy side of things, how we can expand their portfolio, whereas your first home buyer just needs a hand of actually getting into the property market.
For sure.
So it's a real range. It's a real range of different clients, different experiences, different backgrounds, everything like that. So it's a real challenge sometimes, kind of meeting different sort of clientele and their expectations. But at the end of the day, it's a great stuff to do on that side too.
Yeah, for sure.
And in terms of your clients, have you had any good wins lately that you can run us through, and some success stories that you've had?
Yeah, for sure. So actually, one of my lovely first home buyers, allowed to say their name, or?
Yeah,
sure.
Yeah.
Lila. I'll just keep it Lila. Successfully exchanged on her first property.
Nice.
It's a big
Awesome.
one. So very happy for her. So that's obviously a massive win in her books. And on another side of things, we helped one of our long-time investors buy their seventh property, leveraging off their existing book. Yeah.
Can you go into a bit more detail about that investor with their seventh property? Because I find like a lot of people usually struggle maybe with financing usually after the second or third property, because a lot of the banks shading rentals and increasing expenses and things like that, just to be up to date with the rate increases and things like that. It's been a bit more difficult to get additional properties at this current point in time.
For sure. So look, a number of different things happening. Obviously, borrowing capacity's kind of shot due to the rates.
Yeah.
But the good thing too is obviously rental yields and income's gone up due to the repayments going up. A more complex structuring for those type of clients. So for example, if you were to have it by yourself, obviously there's debt to income restrictions if you're an individual. So we find a lot of our more professional investors have properties owned by entities.
Nice.
And you can kind of spread it between different entities and stuff like that. So essentially you're doing individual deals that aren't associated with the particular person. It's creating it like that. So it's just more complex structuring.
And I think that comes down to seeing the right broker, doesn't
Correct.
it? Because like a lot of correct me if I'm wrong and not bagging the industry, but you've got a lot of generic brokers that just sort of deal with first home buyers.
Correct.
Or maybe one investment, and they know how to calculate it, but it gets a little more complex after the second and third.
For sure. And I think relying on your relationships at the banks. For example, I've been doing it for 4 years, but a lot of the relationships at the banks, more complex on the complex side of things, they actually sit down and explain it to you.
Yep.
And as you said, most brokers do deal predominantly with first home buyers, might have worked at the bank very shortly, but a lot of them don't really delve into more complex structures because they're not quite sure how it sort of operates. And I find a lot of brokers refrain from that side too. If they don't understand it, they don't want to give sort of advice around that too. So we rely a lot on the accountants, financial planners especially, to sort of give their clients the advice, and all we need to do is just find a suitable lending option.
And that's where it comes back to the right A team, doesn't
Correct.
it? And we always talk about that, and if I had $1 for every time I said that, and the same as Onis, it's just...
You wouldn't be here right now, mate.
I wouldn't. I'd be building another A team.
That's it.
But it's crazy, like, because if you just have the right people with the right professions, I think everyone just tries to do things on their own to save $1. But you just realize so much being in this industry that the professionals and having the A team makes it perfect and makes it such an easy, smooth transition instead of trying to save a couple of dollars by robbing Peter to pay Paul or try and do your own conveyancing or something like that.
Yeah. Well, mate, on touching on that one too, my existing relationships is a big one. A lot of brokers refrain from that. They tend to just deal with real estate agents to get leads inbound. For example, if you can take, you can utilize the skills of, say, partners that you meet. For example, my conveyancer will assist with first home buyers, kind of relaxing their nerves around the exchanging side of things, assisting on the legal. We sort of team up as a team to get it through. And obviously during that stressful settlement period, it's very important that you have the right team working together. And even on your side of things too, for professional investors, being able to find properties is invaluable. And understanding obviously the metrics behind a pre-approval, it helps the process go through a lot easier.
Absolutely, and I think that's the thing at the moment. Like, speed kills a lot of deals. So if you've got 5 or 6 people in the industry you're dealing with, and one person's not doing the right thing, slows down the whole process, doesn't it? But if you've got the right team and everyone's doing their job, I can leave it with this person. I've got this trusted and things like that. The journey's so much more simple at the end for you and for your client, right?
Of course, and I find as soon as I introduce, so we'll get a customer in and we introduce them to, for example, you guys. At the end of the process, we find that they're a lot more receptive to obviously recurring business and stuff like that. Not only are we helping them buy a first property, maybe the 7th property, whatever, just making their life much easier, we find is a big help on their side too. Yeah.
And then they're ready to go again, whereas someone's done it themselves. They're like, oh my God, that took 6 months. I don't want to buy another property ever again. It was hell.
The PTSD.
Yeah, pretty much.
Yeah, Tom, mate, I've been hearing a couple changes within the industry. I don't know if they're whispers or if they're actual facts, but I want to get your take, mate. So one of them are stamp duty reforms.
Yep.
And that's massive, because if they're reforming stamp duty, then you can pretty much reform anything, mate, in my opinion. So yeah, if you don't mind sharing what you've kind of come across and how this would actually help our audience in regards to acquiring their first or their next property.
For sure. So look, obviously the main one that's been all over the news or everyone's been raving about is obviously the stamp duty annual. Instead of an upfront, it's an annual levy.
Yep.
It will help immensely. Up to 1.5 million, you can essentially, say if you were to purchase 1.5, you'd usually pay around 66,000 roughly in stamp duty or costs.
Wow.
That obviously is to be paid over a compounding term now. But the initial upfront purchasing power increase significantly helps the buyer. So, for example, I had a potential scenario came through last week for $1 million purchase. We couldn't assist them 6 months ago before this new reform came through, just due to a deposit, not a borrowing capacity problem. But now that we can get rid of, say, the 40 grand in upfront costs, it's allowed us to push in front of that benchmark, and we can now successfully finally get on the track of finding a property for around $1 million.
Wow, that's interesting.
Yeah, very helpful.
That's a really good point. I didn't think of it from the deposit perspective, but that's a really good point, isn't it? Because a lot of it, depending on the price of the property, that is quite a percentage of your deposit, isn't it? So
Correct.
if you can minimize that, it's almost like having like an LMI waiver or something, or pay LMI monthly and not calculate it, sort of thing. So it does really help with the deposit side of things.
And on top of that, also for smaller range purchases, you can still get a full exemption up to 800,000, or sorry, a partial exemption up to 800,000 and a full exemption up to 650. And that's still very helpful for very, very beginning first home buyers with say $30,000-$40,000 deposit. And on top of that, there's an LMI waiver. It was called the FHLDS scheme. I believe it's called something else now. And what I found is with combination of the stamp duty concession and the lender's mortgage insurance concession, people with a deposit as low as say 30,000, which we had yesterday, have the purchasing ability up to 550.
Crazy.
Yeah.
Amazing.
Yeah.
People drop that on a car, 30 grand
No, they
cash.
do. Or a watch.
A watch these days,
Or a boob job. Keep it G-rated, all right, mate.
Thought they were only 10.
We're not going to get into that. Mate, and policies, mate. Everything's a policy when it comes to finance nowadays. So policy this, policy that. Policies change, policies don't change. What's the landscape for policies right now, and where is everything at? If you can give us like a nice rundown or some kind of overview.
I've got so a good example is the banks do They are slow usually, but they're good to follow when the markets when they see business going down. Obviously, they need to come out with emergency measures as the borrowing capacity issues have come through. Usually, what the banks have been doing with rental income is shading 20%, so they're effectively using 80% your rental income for servicing purposes. We got lenders now, so Advantage, which is backed by NAB, will do 90% of your rental income, which could potentially increase your borrowing capacity by approximately 8%.
Wow.
Yeah. So if you have an investor with, say, 5 properties, and there's a bank that can take an extra 10% of each rental income on each property, that's a significant increase in their overall borrowing capacity too.
Wow.
Yeah. Another one too is obviously the self-employed aspect. There's a lot of banks doing 1 year's financials. So ANZ's a prime one.
Yep.
We're heading into obviously FY23. We're getting there. We're almost at halfway through now. But due to the government ATO cash boost, so when COVID was happening, the government was obviously flinging out cash left, right, and centre, which we're seeing now. But the beauty is the self-employed customers that receive, say, the ATO cash boost or the COVID support payments, ANZ is one of the lenders that can actually use that income, even though it was government income, for borrowing capacity purposes too. Yeah, so say their net profit's 100,000, they have maybe had some COVID boosts of maybe 50, 80 on top, they can use 180,000 effectively for borrowing capacity on 1 year's financials. Yeah. Usually they would average the 2 years and they go with the average, but if they do 1 year in isolation plus a cash boost plus good net profit, it's effectively boosting borrowing capacity quite heavily for self-employed.
Interesting. That's good to know.
And there's over 40 different lenders, 40 different policies, so it's forever changing.
And if you can provide like just a high level kind of approach to, I don't know, if there's a model that you typically go by, say, if I don't service with a first tier, second tier, third tier, what's that process like? Say, if I get knocked back from a CBA because I think I'm too good, for example, but they think I'm not because I've had a couple defaults, for example. Okay. What's that kind of process like?
No, for sure. So there's a number of different lenders for different circumstances. So we're looking at, say, credit scoring problems. There are a lot of lenders, some of the third tier ones, Pepper Money is one of them. They will charge higher rates, obviously, for the risk rating, but there still are options out there. And obviously, we can work on the credit scoring issue in the interim. So say if we had to go to a lender such as Resimac on a higher interest rate, at least you get into the property market, so at least you own a property, start building equity whilst maybe we sort out the credit situation. And then as soon as we're in a position to refinance you to a tier one, so CBA, for example, we'll just go ahead and refinance them.
Wow.
Better example though, just to give you a niche one. So there's a few non-bank lenders such as Firstmac, for example. Usually when you're doing servicing, a bank will apply a buffer to your repayments for borrowing capacity just to be conservative. Some of these non-bank lenders don't actually apply a buffer at all, which means effectively they can boost your borrowing capacity. If your repayments are $3,000 a month, they'll actually use $3,000 a month, not apply a buffer and say $5,000. Yeah, so effectively pushes your borrowing capacity that little bit further. Yeah. You can also restructure, refinance, put all your existing properties on interest only, go to these non-bank lenders to take actual repayments in isolation, use the actual repayment interest only, and it effectively can boost the borrowing capacity quite significantly compared to the normal lender.
Nice.
On not too low, not too ridiculous of rates too, for example, with Firstmac.
I had a mate that threw a term at me. It went over my head. You probably know him. But the term was security swap.
Okay.
Have you heard of that before?
When he says security swap, is he any background towards that one? Or?
Security swap in the sense of changing an asset you probably own for another asset.
Okay.
Have you heard of that?
I've heard of, I don't know if he's talking about cross-collateralization when you combine your properties values together, or are you speaking of, say, a non-liquid asset to a property? What do you quite mean?
Yeah, so a non-liquid asset, so I own this cup.
Yep.
And I want to swap it for another cup.
Okay.
And then just do like a quick switcheroo.
Look, I think bridging finance would be something maybe similar there. So, for example, you own a property right now, you want to move into a new property or buy a new one. Obviously, selling your property is a quite intense process. And then what do you do between when you don't have another property? So lenders do offer bridging finance, which is effectively giving you the approval to go buy another property, and then you have 6 months or so to sell the existing one in order to pay out that existing debt. Sorry if that's not as close to the 1 year after, but it sounds a bit complicated, the cup one.
Yeah. Fair enough. What are your thoughts there, Dan?
Yeah, I think you're talking about a security swap per se. That would be more conveyancer, solicitor sort of questions around the legalities of transferring the stamp duty.
Yep.
So think that would be more of a conveyancer sort of solicitor question.
Solution.
Yeah, that would just be if you had a property that was $600,000 and you're purchasing something that was another $600,000, you would pay the stamp duty and then transfer the asset, but you would also need to sell them in the interim as well. So
correct.
That would also get quite complicated too from that perspective. In terms of the policies coming out next year and some changes, do you think what I see is a lot of banks are receptive to lend to particular people at the moment, but they're also looking at opening their appetite for other types of people, opposed to now maybe not be so much of a first home buyer with the rate sort of thing, but your seasoned investor, like as you said, your seventh property and things like that. I feel there is some banks that always have an appetite for good investors.
Yep.
Are you finding that as well? Or?
I find so obviously there's two different channels. You've got the residential normal, and then you've got semi-private channels. So for example, your Westpac privates, your CBA privates, stuff like that. A lot of their policy and the way they structure deals is more around client profile.
Yep.
So for example, a professional investor with multiple assets, maybe 20 million property, not much income, maybe they're retired. Could be a situation when we take to a private lender, such as Westpac Private. They would then do maybe a scenario based off the profile and the risk rating and come up with a scenario or a very tailored solution there. But in regards to the normal residential channel, so your typical, say, first home buyer or typical buyer, the only thing I'll see the banks doing is just maybe loosening up on their maybe HEM policies, so household expenditure monthly policies.
Yep.
And a lot of their shading, example for the rental income I mentioned before. Yeah. So small things that they can add to help boost borrowing capacity, but more of the tailored stuff is depending on the type of client you're looking at. Yeah.
Yeah, it's quite interesting where if they want to lend a bit more money, they can just swap the shading from 80 to 90 or take actual opposed to projected, and then
Correct.
Your borrowing capacity is huge. But I feel like the particular banks always want to help good investors. Like people say, oh no, the banks aren't lending. The banks are always lending.
Correct.
You just got to go to the right people for the right strategy.
Of course, you've also got to understand their policy. And when it comes to obviously, why would you use a mortgage broker? People think obviously our only task is to secure a better interest rate. Yep, we're there obviously for that option too. But knowing all the different policies of the different lenders and how it could affect your position, maybe boost borrowing capacity, that might be more worthwhile to you than maybe saving a couple $100 a month on your interest. Maybe being the ability to buy another property might get you over the line compared to maybe getting a $4,000 cash back with St. George on a cheaper interest rate. Yeah.
And I think the people that sort of chase the rates and things like that, you're probably just better off letting them go online anyway, because they're just rate chasing. They're trying to get that shiny blue crystal, opposed to like you would be more solution based and try and create that strategy for people.
At the same time, we've got a strategy for all kinds of customers. So the ones that are obviously rate focused, there's plenty of lenders. Suncorp, for example, is doing no fees, cashback, and quite good interest rate pricing for the broker channel.
Okay.
And what we do in the tail end too is once we settle, a lot of brokers neglect their clients from there. They go, deal's done, whatever. But what we are after is a 6-month follow up, and we're consistently watching the market in the background on their behalf anyway. So we track it in the background. And if there's any better options or any better, say their rate's not as competitive as it could be, we'll actually reach out to our own clients and let them know that there's a better option elsewhere. Awesome. And kind of get on that front foot. Well, obviously, we don't want to lose them, but at the same time, we want to make sure that they're over the compounding term, saving as much interest as possible. Yeah. It really just depends on their requirements and objectives. And every client's different. But as we get to, obviously, I deal with them for months and months and months, we get to know each other a lot more. And as I get a better understanding of their situation, we can better assist going forward too.
Yeah, nice.
Yeah.
And that makes sense too. Yeah, like I guess a lot of people, they just go with a bank or go with a broker and then just let it sit there, and they're not getting reviews and annuals and half yearlies and things done to see if it actually is competitive. We find the same in the property management. People who just had the same rent for like 7 or 10 years and had no increase, and then they always complaining about inflation, but it's like, well, you've got an investment, so that should be inflating as well. And then they come and see us, and then it's just absolutely game changing for them.
Yeah, no, for sure. And I think the more value add you can add to your customers' situation in life, the more obviously value you add, the more they'll return the favour. It's all about assisting them at the end of the day and getting their goals achieved.
Yeah, absolutely. And the only other thing I was going to ask is there any other terms out there that they're looking at? Like, I know the traditional loan term's 30 years.
Yep.
But obviously the way the world's changing, things are more expensive, maybe is there option for longer durations?
Yeah,
or
for
other
sure.
things
So
like that?
Ubank, great example, 35-year loan term on refinances and purchases.
Okay.
They're also doing cash back on purchases, which is amazing for our first home buyers. It gets rid of the conveyancing costs, which averages around $2,000 for the lawyer.
Yep.
And assists immensely there. And on top of that, Pepper Money is doing a 40-year loan term. Yes. So the reason they do that is to assist people who are in situations where a lot of bad debt exists. So, for example, personal loans, credit cards, car loans, stuff like that. If we can stretch the capacity on the home loan, consolidate the debt, over the long term, you will be better off as long as we get you refinanced to a better lender as soon as possible. Yeah. Not to say Pepper isn't good. It's just they have their own tailored solutions to whatever situation's out there too.
They got their own strategy for the right
No,
person.
for sure. Excellent lender.
Yeah, absolutely. And I think in terms of interest rates, do you see them sort of like having any stop, or you still think they're going up?
I really wish I could predict it. I really could. Every week, that first week of every month, I'm terrified of what the RBA is going to do. But I tend to watch what's happening in the US, and the US, as long as they're still kind of panicking, I'd assume that the rate's going to continue to go up.
Yep.
And I believe it needs to go up probably by another maybe 5 basis points in order to maybe they'll start thinking about stagnating. But what it's doing to the borrowing capacity side of things is about a year ago, I could get maybe a typical $1 million loan on the average income. It's probably reduced now to maybe 800, 780. Significant. Yeah.
The other thing too is people freak out about like the rates and things, but also the banks are already factoring in a 2.5% buffer anyway. So when they're looking at like example, like say 5% now, the banks are probably assessing it at 7.5 to 8, most of them. So even if we do have a few more increases, the banks already checked that out for you, but people don't actually realize that.
Yeah, and look, another, say 6 months, beginning maybe January this year, the assessment rate was 4.99 with some lenders. I won't mention which ones.
Wow.
But yeah, so if the rates are almost already surpassing that, say, buffer, it will be very interesting to see what happens when the fixed rates start to roll over. I know a lot of the fixed rates that we were securing in 2021, 2020, early 2022, they will begin to start rolling over in the next 1 to 2 years. And people will be going from 1.89% to essentially 5%, and it's gonna be a very big culture shock. Or
I'm one of those people. I've got a couple with St. George and Westpac on 1.79 that I'm a bit concerned about the rollover.
The honeymoon rates.
Oh gosh.
Yeah.
And it was a good rate at the time, and I remember when I locked in 1.79, I was speaking to other people and they're like, why would you fix that in? Like, rates are at a record low. And I'm like, obviously that's why I'd fix it in, because they're like the lowest they've been in the history of rates, property and finance in Australia. So like people were like, oh, but they might go down like a little bit more, so I'm just going to wait. It's like, wait for what?
Well, if you look historically, the rates, they were as low as they would ever get last year, and it doesn't look like that probably will return for if ever, to be honest.
Yeah.
There was a very unique circumstance. Obviously, with the COVID, the Reserve Bank needed to react. They might have reacted a little bit too aggressively. But on top of that, I had a lot of customers that got the 1.99 4-year fix for CBA, for example.
Oh, wow.
So they might actually be laughing over the next few years.
Maybe
Fingers
laughing.
crossed.
Absolutely. And I think that's coming to the end of our podcast. Onis, have you got any more questions for Tom?
Mate, that's pretty much it. I guess for Tom personally, I'd ask you what your philosophy is when it comes to property investing and you getting into this space, and what your long-term goals are with your clients and for yourself also.
Yeah, lovely. Yeah. Mate, I think as the saying goes, it's never a good time to buy property. During COVID or last year even, it was too competitive. You weren't able to even purchase, or you might be purchasing for far more than what it's worth. 2018, it was tough to get. The apartment market had a big issue with the valuations, and right now we're having problems with borrowing capacity. So it's never really a good time to buy per se, in retrospect, if you listen to what people say. But if you have the means or the ability to do so, and you have the, say, time and place, that you have the capacity, everything's ready to go, maybe just take advantage of that time to purchase, get a property, take advantage of building the equity over the long term, because over the long term you should be in the green, fingers crossed, if we go off historical figures. So yeah, realistically, I would say if anyone's on the fence about purchasing, have an idea of what you can afford. At least know what you can afford. Get someone, a broker, banker, just to give you a rundown of your borrowing capacity. Maybe have a chat with people like yourself just to see what sort of property is out there at the moment. And if it works and you feel like it's a time in your life where it's something you could do, I'd say do it. But on that side of things, it's entirely up to them. But we're here to help regardless. In regards to in the next near future, hopefully we could potentially buy some more property for myself, which would be good.
Nice, we can help you out with that.
Yeah,
Don't worry about that.
No, of course. In the next year or so, I'm hoping some good opportunities come up. Looks like WA is looking quite good at the moment too.
Oh yeah, it's going off like a frog in a sock. Thanks for coming on,
Thanks,
Tom.
Really appreciate it.
Appreciate your time, mate.
Lovely.
Hey guys, this is Onis
and Dan here.
Thank you very much for listening to our podcast.
If you guys like the podcast, smash the like and subscribe button.
And we look forward to having you back on our next episode.
And if you have any questions for us or our guests, please comment below.
Or send us an email to info@windowpropertygroup.com, and also slide in our DMs on Instagram, TikTok, and LinkedIn.